Extraordinary Heroic Day, everyone! Hi, we are Form Academy, your online training partner in becoming extraordinary and heroic professionals. Today, we will discuss financial statements. The learning objectives in this video are the following. First, introduction to financial statement preparation by describing the primary forms of business organization. Next, basic requirements in preparing the financial statements. Next, knowledge about financial statements, its definitions, users, and components. Next, identification of each user and the reason why they need the information from the financial statements. Next, discussion and illustration of each component of financial statements. Then lastly, sample of financial statement per industry. First, if we talk about financial statement, we will talking about business. A business may be organized as a sole proprietorship, partnership, and corporation. Sole proprietorship, a business owned by one person. It is simple to establish. It is single ownership because the owner has control and the proprietor is personally liable. Financing may be difficult because it is a one-man capital, and the transfer of ownership may be difficult. Partnership, a business owned by two or more people. It is simple to establish. It is shared control. It has broader skills and resources, and the partners are personally liable, and the transfer of ownership may also be difficult. Corporation, a separate legal entity owned by stockholders. It is easy to transfer ownership with greater capital raising potential and with lower legal liability. It has unfavorable tax treatment because there are BIR compliances that should be met when it comes to corporations. After these businesses is already registered to SEC, BIR, and LGU, they will start to operate the business and record their business transaction and prepare a report called financial statements. So what are financial statements? Financial statements are reports that summarize the financial performance, financial position, and cash flow of a business entity or company. When we say a business entity, it can be corporation, partnership, or sole proprietorship. It also shows the result of management's stewardship of the resources entrusted to it. Here is the illustration. Financial statements are documents reflecting the money or financial resources of the company. It tells us where the money came from, meaning what are the sources of the capital. Was the money contributed by the owners or shareholders of the company, or did it came from borrowings? It also tells us where the money went. Was it used for capital expenses, such as acquiring property, plant, and equipment, or payment of rent and other business expenses, or the money spent on paying operating expenses, such as utilities and salaries and wages? The financial statement also shows us when the money is at present, reflected in the cash balance of the company. How liquid is the company? Is the company have sufficient cash to pay its existing obligation, both short and long term? How much is the company's working capital? Aside from the sources of financing and the spending of the company and the ending balance of its cash, financial statement also tells us where the money is going. and whether will it be used for expansion or reinvestment objectives of the company. All of this information is contained in the financial statements. To elaborate more, since the financial statements are reports, we will discuss first the process of how to come up with these reports. Here is the illustration. First, we have the financial data, which is actual transaction carried out by the business. For example, sale of goods, purchase of goods and services, and payment of expenses. These transactions need to analyze according to the type and nature of the expense, then record by preparation of journal entries, summarize all the entries, and record to the company book of accounts. It can be cash receipts book, cash disbursement book, sales book, purchase book, and then after summarize the total amount per account, it will record in a general ledger. Make sure that the chart of accounts is updated and well organized. All accounts with balances will be forwarded to a trial balance, and from there, financial reports can be created. We will discuss one by one later each report. In the preparation of financial statement, we should start with proper order. First, we have to prepare the income statement, meaning we have to get all revenues and expenses on the trial balance and prepare the statement of comprehensive income. Actually, there are two reports here, the statement of profit or loss and the statement of other comprehensive income, if any. But for our illustration, we have simple statement profit or loss. The profit and loss statement is the revenues earned, costs incurred, and resulting profit generated over a particular accounting period. Next, we will prepare a statement of changes of equity, wherein after we have recorded and found out that we have an income on our statement of profit or loss, we will be reflected on the statement of changes of equity that is added to our equity balance. We will show you the sample later. Next, after the preparation of changes of equity, we will prepare a statement of financial position, wherein we have to put all balances of assets, liabilities, and equity from our prepared trial balance together with the recorded income closed in the return earning balance, which is part of the total equity. Then we have to prepare our statement of cash flow, which is listed all the cash receipts and payments over a particular accounting period. It usually broken out into operating activities, financing activities, and investing activities. And lastly, we have to prepare notes to our financial statement wherein we have to put significant accounting policies, including measurement bases and relevant policies to understand the financial report. And take note also the heading of each financial statement report. It should have the following details such as the first line, we have the name of the company. The second line, the name of the statement. The third line is the reporting period. The fourth line is the presentation currency. On the third line, the reporting period, only the balance sheet shows the balance of accounts at a particular date. And the statement of comprehensive income, statement of changes in equity, and statement of cash flow covered a period of time. We will discuss it further by giving illustration later. Now, who are the users of the financial statements? Of course, first on our list are the owners and investors. Stockholders of corporation need financial information to help them make decisions on what to do with their investments or shares of stocks, deciding whether they hold, sell, or buy more. Prospective investors need the information to assess the company's potential for success and profitability. In the same way, small business owners need financial information to determine if the business is profitable and whether to continue, improve, or drop it. Next, management. In small businesses, management may include the owners. In huge organizations, however, management is usually made up of hired professionals who are entrusted with the responsibility of operating the business or a part of the business. They act as agents of the owners. The managers, whether owners or hired, regularly face economic decisions like how much supplies will be purchased, do we have enough cash, how much did we make last year, did we meet our targets, all those and many other questions and business decisions required analysis of accounting information. Next, lenders. Lenders of funds such as banks, financial institutions, and bondholders are interested in companies' ability to pay liabilities upon maturity. Next, creditors or suppliers. Like lenders, trade creditors or suppliers are interested in the company's ability to pay obligations when they become due. They are especially interested in the company's liquidity or its ability to pay short-term obligations. Next, government. Governing bodies of the state, especially the tax authorities, are interested in an entity's financial information for taxation and regulatory purposes. Taxes are computed based on the result of operations and other tax bases. In general, the state would like to know how much the taxpayer makes to determine the tax due. Next, employees. Employees are interested in the company's profitability and stability. They are after the ability of the company to pay salaries and provide employee benefits. They may also be interested in its financial position and performance to assess possibilities of company's expansion, as well as career development opportunities. Next, customer. When there is a long-term involvement or contract between the company and its customer, the customers become interested in the company's ability to continue its existence and maintain the stability of operations. This need is also heightened in cases where the customer depends upon the entity. For example, a distributor or a reseller. The customer in this case is dependent upon the manufacturing company from which it purchases the item it resells. Next, general public. Anyone outside the company such as researchers, students, analysts, and others could be interested in the financial statements of a company for some valid reason, like be it for personal research, industry and sector analysis, school reports, or simply to satisfy one's curiosity. The users may be classified into internal and external users. Internal users refer to managers who use accounting information in making decisions related to the company's operation. External users, on the other hand, are not involved in the operation of the company but hold some financial interest. The external users may be classified further into users with direct financial interest such as owners, lenders, and creditors, and the users with indirect financial interests, such as government, employees, customer, and and the general public that use information in research, financial news, and the like. Let's move on to the components of a set of financial statements. We have here the statement of comprehensive income, also known as income statement or statement of operations. The statement of comprehensive income, there are two reports. One is a statement of profit or loss, and the other one is the statement of other comprehensive income. We also have the statement of financial position, also known as balance sheet. Next is the statement of changes in equity. Next is the cash flow statement. And lastly, notes to financial statements. Okay, let us start first with the statement of comprehensive income. It measures the overall performance of a company. This report shows all revenues of the company and all expenses it incurs over a period of time. Basically, a statement of comprehensive income tells us what a company earns over a period of time. So the basic equation is sales revenue minus expenses are equal to net income. Sales revenue is what a company earns for a sale of goods and or services. Expenses include costs or operating expenses. When we say cost, it is directly attributed to the goods or services such as cost of material and labor. When we say operating expenses, it includes salaries and wages, rent expense, utilities, and the result after deducting these expenses is the net income. How is the statement of comprehensive income presented? In this illustration, we can see four lines on top as heading. The first line is the name of the company, which is ABC Corp. The second line is the name or component of the financial statement, which is the statement of profit or loss. The third line is the reporting period, which is for the period ended December 31, 2021. The fourth line is the presentation currency, which is, in this example, it is in a Philippine peso. As you notice, it is stated for the period ended December 31, 2021, meaning it covers from January 1 up to December 31, 2021. Assume that it is calendar year, so this is the revenue and expenses for the whole year. Every income statement begins with the company's revenues or sales. Here, in our example, the company ABC Corp is a sales of services. After deducting the cost of service, operating expenses, as well as tax expenses, we arrive at net income. On this example, we have 923,330 as net income. To know how profitability the company is, you may look at the company's statement of profit or loss report. The question is, how do we really know if the recorded transaction is the revenue and expenses for a particular period? Is it only the discretion of the recording of the bookkeeper or accountant, or it has to do with the specific guidelines on the recording of revenues and expenses? So, we will go back to our accounting history wherein the time how accounting and double entry originates. To discuss this, we have a sample process flow. So, in recording of transactions, we have a basis or guidelines. This is called the conceptual framework. We follow the principles that provide the frame for financial reporting, and this is GAAP. There are lots of principles such as accrual principle, matching principles, and materiality, and more. I have here a sample which is accrual principle that states income is earned when the service is rendered regardless of when cash is collected. Expense is incurred when the service is received regardless of when cash is paid. So basically, if we will record transactions, we have to consider these principles, the GAAP. Next, on our sample illustration here of statement of comprehensive income, we have here our revenue. Since, as I said earlier, that ABC Corp is a sales of services, it has a service income and then other income which is from bank interest income. Next, we have a direct expense, which I already explained earlier. It is a cost direct attributed. We will deduct it from the revenue as well as the operating expenses. If there is computed tax expense, we will also deduct it to arrive at the net income of 923,330 pesos. I have here a sample of statement of comprehensive income from the manufacturing industry and from the government. This is from manufacturing industry. As I mentioned earlier, it is always revenue or income at the first account title, then expenses. The difference in manufacturing industry versus the service industry, the manufacturing industry have a cost of goods sold account title. Next is the government. Government comprehensive income, same with the service industry, wherein with service income, less operating expenses, then net income. They use word surplus as their account title for net income. Now we go to the statement of financial position, also known as balance sheet. The, the balance sheet is the company's asset, liabilities, and equity from the inception of the business are summarized and presented in this report. Statement of financial position measures overall financial health of a company. The balance sheet is categorized into three. We have asset, liabilities, and equity. The general equation is assets less liabilities is equal to equity. What are assets? These are things the company owns, such as cash, marketable securities, inventories, property, plant, and equipment, and the like. We will discuss assets later one by one. What about liabilities? This is what a company owes to its lenders or creditors such as loans, rent, and utilities. And equity, also known as retained earnings and capital, is what we get after deducting the liabilities on the asset. It tells us about ownership. How does statement of financial position be presented? In this illustration, we can see four lines on top as heading. The first line is the name of the company, which is ABC Corp. The second line is the name or component of financial statement, which is the statement of financial position. And the third line is the reporting period, which is as of December 31, 2021. The fourth line is the presentation currency, which is in this example, it is in a Philippine peso. On this, it is stated as December 31, 2021. The question is, when did the reporting period start? If the company commenced on May 1, 2020, it means that the reporting period starts on May 1, 2020 up to December 31, 2021. Now, for ratio analysis, you can find the figures in the balance sheet that will measure the company's liquidity and stability. In this sample, we go back to the equation of assets less liabilities equals equity. On these figures, the asset, which is 48 million less liabilities of 22 million, equals the equity of 25 million. Or on the other way around, in which an asset of 48 million is equal to a liabilities of 22 million plus equity of 25 million. It is the sense that the total assets will always be equal or balanced to the total liabilities and equity. So now, to further discuss the statement of financial position and its components, we will discuss one by one the accounts or sample chart of accounts that included on these reports. Based on our illustration here, we have assets, accounts such as cash, trade and other receivables, other current assets, property equipment, intangible asset, and deferred tax asset. On our liabilities account such as trade and other payables and advances from related party. And on our equity account such as capital stock and retained earnings. So what is assets? An asset is any resource owned or controlled by a business or an economic entity. It is anything tangible or intangible that can be used to produce positive economic value. Tangible, meaning a thing that is perceptible by touch, such as computers and laptops and the like. Intangible, meaning unable to touch or not having a physical presence, such as application software, patents, and the like. They are classified as current and non-current assets. So how we classify if the asset is current? As per International Accounting Standard-1 or Philippine Accounting Standard-1 financial statement, an asset shall be classified as current when it satisfies any of the following criteria. So let's read what are these criteria. So first, it is expected to be realized in or it is intended for sale or consumption in the entity's normal operating cycle. It is held primarily for the purpose of being traded. Next, it is expected to be realized within 12 months after the reporting date. Next, it is cash or cash equivalent unless it is restricted from being exchanged or used to settle a liability for at least 12 months after the reporting date. And if not fall for this criteria, the asset is classified as non-current. Now, let's go back to our sample statement of financial position of ABC Corp. We have cash as our first current assets. So what is cash? Cash are bills, coins, bank balances, money orders, and checks. Cash is used to acquire goods and services or to eliminate obligations. On the statement of financial position of ABC Corp, it has cash, but normally on other businesses they have cash and cash equivalents as account title. When we say cash equivalents, this includes treasury bills, commercial papers, and treasury notes. In this sample, the breakdown of cash is cash in bank of 17,765,224 and a revolving fund of 30,000. It has no cash equivalent, so the account title used is cash. Next current asset, the trade and other receivables. So let's define trade receivables and other receivables. So trade receivables are defined as the amount owed to a business by its customers following the sale of goods or services on credit, also known as account receivable. While other receivables refers to money owed from third parties to a company. On our sample here, the 28,379,463 is from the receivables of the customers amounting to 28,256,503 and the receivable from third party amounting to 122,960. inventory, but we don't have inventory in our example statement of financial position. But as defined, the inventory is the accounting of items, component parts, and raw materials that a company either uses in production or sells. So, usually, if the company business is engaged in sales of goods, the actual inventory count will be normally reflected on this account title. Next, we have other current assets. So this account can be uh, is categorized of things of value that the company owns and benefits from. So this account can be prepaid expenses such as prepaid rent and prepaid insurance. In our example, we have 1.2 million as other current assets. So let's move on to the non-current asset. We have here property, plant, and equipment. As defined, these are tangible items that are held for use in the production or supply of goods or services, for rental to others, or for administrative purposes, and are expected to be used during more than one period. Since property, plant, and equipment, a non-current asset, has a cost and limited useful life, and its value eventually declines, it follows that a charge should be made in profit or loss to reflect the use and that is made of the asset by the business. This charge is called depreciation. As you can see in our example here, there is a contra asset account, accumulated depreciation, that was used to less or deduct the value of the asset. In our example, we have a computer and office media equipment recorded net of accumulated depreciation, which is the total property, plant, and equipment amounting to 1,096,66 is from desktop and laptop of 1,040,080 and the office equipment of 55,986. Next non-current asset is intangible asset. So, as defined, intangible asset is an identifiable non-monetary asset without physical substance. Example of intangible assets includes computer software, licenses, trademarks, patents, films, copyrights, and import quotas. Same with property, plant, and equipment, its value eventually declines based on its useful life, and the difference is that on property, plant, and equipment, accumulated depreciation is the term because it was tangible, and on intangible asset, it was accumulated amortization. Next is the deferred tax asset as defined. Deferred tax asset is an item on a company's balance sheet that reduces its taxable income in the future. So such a line item asset can be found when a business overpays its taxes. This money will eventually be returned to the business in the form of tax relief. Yes, we are done with the assets. So now we go to the liabilities. So liabilities can be classified also as current and non-current liabilities. So how do we classify if the liability is current? As per International Accounting Standard-1 and Philippine Accounting Standard-1 financial statements, a liability shall be classified as current when it satisfies any of the following criteria. So let's read what are these criteria. So first, it is expected to be settled in the entity's normal operating cycle. And next, it is held primarily for the purpose of being traded. Next, it is due to be settled within 12 months after the reporting date. And the entity does not have an unconditional right to defer settlement of the liability for at least 12 months after the reporting date. And if not fall for this criteria, the liabilities is classified as non-current. Now let's go back to our sample statement of financial position of ABC Corp. We have trade and other payables. As defined, trade payables are obligation to pay for goods or services that have been acquired from the suppliers in the ordinary course of business. While other payables, these are residual trade or non-trade payables that not been specified by the company or regulations or do not meet the criteria of being classified separately. So as to our example here, we have 21.5 million as trade and other payables, in which the 10.6 million is from trade payables and 10.9 million is from other payables. So we also have here the advances from related party, because in our example ABC Corp is a subsidiary company and has a parent company that initially supports or finances its subsidiary when it comes to its payables. Now, our last account title on the statement of financial position portion is the total equity. On our example, it is a capital stock that is subscribed and paid up and the return earnings, which 25,829,042 is the total equity, which is from a breakdown of 25,121,100 capital stock and 707,942 return earnings. So, that was the statement of financial position. If we go back to our equation, the uh, total asset is equal to total liabilities and equity. So I have here sample of the statement of financial position from the manufacturing industry. If you check the sample, it was same as our illustration earlier, wherein the assets are classified into current and non-current as well as liabilities. It was also same, the assets are balanced or tally with liabilities and equity. So I have also here sample of financial statement of financial position from the government. So if we check the sample on this first page, we have the assets, so classified as current and non-current. And the next page, so we have here the total assets, and then total asset less total liabilities is equal to total net equity, assets equity. Now we proceed to the statement of changes in equity, or also called as statement of changes in stockholders' equity. So this report accentuates changes made in the equity investment of owners. It must contain the following: increase in net income during the period, additional capital contributions, withdrawals, dividends if any. The statement of changes in equity shows us two things: the transactions that either increase or decrease equity. As you can see in the illustration, the same with the heading. The first line is the name of the company, which is ABC Corp. The second line is the name or component of the financial statement, which is a statement of changes in equity. The third line is the reporting period, which is for the period ended December 31, 2021. The fourth line is the presentation currency, which is in this example, it is in a Philippine peso. The transactions, we have here the beginning balance of 10.4 million plus additional capital of 14.7 million plus the balance of the retained earnings, which is 707,942. As a result, we have an ending balance of equity amounting to 25.8 million. On this, we have an increased capital from 10.4 million to 25.8 million. So I have here a sample of statement of changes in equity from the manufacturing industry. If you check the sample, it was same as on our illustration earlier, wherein it reflected the increase or decrease in equity. We also have here the sample of statement of changes in equity of the government, wherein the movement of the equity is also reflected. Now we go to the cash flow statement. Cash flow statement shows all the cash receipts, cash inflow, and cash disbursement, cash outflow of the business. Remember, only those transactions that may affect the cash account will be included in the cash flow statement. Transactions such as purchase of office supplies on credit, meaning no cash outlay, will not be part of the cash flow statement. However, purchase of office supplies in cash will be reflected as cash outflow in the cash flow statements. So cash flow statements are classified into three categories. We have operating activities, investing activities, and financing activities. In operating activities, comprise the primary activities for which the organization is in business. The sample of these as inflow will be the cash collection from customers if the company generates revenue and deliver goods or services to the customer. The sample of this as outflow is the expense incurred in earning revenue. Investing activities, obtaining resources or assets needed to operate the business. So the source of funds or inflow of these are when people invest in the business, if the company sell a property, plant or equipment, or if the company have collection of principal on loans to other businesses. While uses of funds or outflow of these are when the company invests in another business, or if the company purchase assets that are going to benefit the business for several periods. While the financing activities to start or expand a business, the owner or owners quite often need cash from outside sources. So sources of funds or inflow is the borrowing from creditors, which creates a liability. It can be bank loan, debt securities, goods on credit from suppliers, or selling ownership interest in the corporation to the shareholders. Uh, and the uses of funds or outflows is the payment of dividends to stockholders and redemption of long-term debt or purchase of treasury stock. In this illustration, we may choose the direct or indirect methods to show the inflow and outflow transactions of the operating, investing, and financing activities. The presentation is also the same with 4 lines heading. The first line is the name of the company, which is ABC Corp. The second line is the name or component of the financial statement, which is statement of cash flow. The third line is the reporting period, which is for the period ended December 31, 2021. The fourth line is the presentation currency, which is in this example, it is in a Philippine peso. Either direct or indirect method, the total of operating, investing, and financing activities are the same. As I said earlier, the amount here is the inflow and outflow of cash from 3 activities. And the ending balance is the same with the cash balance on the statement of financial position, which is 17.7 million. So I have here a sample of cash flow statement from manufacturing industry. So if you check the sample, it was same as in our illustration earlier, wherein it reflected the inflow and outflow of cash from its operating, investing, and financing activities. We also have here the sample of cash flow statement from government. It also reflected the inflow and outflow of cash. Now, we go to the notes to financial statements, also known as footnotes. So as defined, these are explanatory notes that provide detailed information on the accounting policies, disclosure of accounts, and the amounts not presented in the financial statements, and any additional information such as contingent liabilities, contract, contractual commitments, and non-financial disclosures. So we have to remember that notes to financial statement are an integral part of the financial statement, since companies are required by what we call the full disclosure principles. Note to financial statement serve as the basis in the preparation of financial statement, particularly how a company arrives at its amount and overall presentation of its financial statements. So on our note disclosures, the following should be included in the notes to the financial statements. So let us read one by one. What are these disclosures? So first, information about the basis of preparation of financial statements and the specific accounting policies used. For example, going concern or in liquidation. Next is the information required by international financial reporting standards or that is relevant to understanding the statements that are presented elsewhere in the financial report. Next, significant accounting policies including measurement basis and the relevant policies to understanding the financial report. Next, judgment. Apart from those involving estimations, the management has made in the process of applying the entity's accounting policies and that have the most significant effect on the amount recognized in the financial statements. Next, a key assumption concerning the future and other key sources of measurement, uncertainty that have a significant risk of causing material adjustments to the carrying amounts of assets and liabilities in the next 12 months. And lastly, information that enables users of its financial statements to evaluate the entity's objectives, policies, and processes for managing capital. To summarize the components of financial statements, we have statement of comprehensive income showing company's revenue and expenses. We have statement of financial position which is categorized into three: assets, what are the company owns, and liabilities, what the company owes, and equity, what the company gets. We have cash flow statement which is the inflow and outflow of cash through its operating activities, investing activities, and financing activities. We have statement of changes in equity that shows an increase or decrease in ownership. And finally, we have notes to financial statement as supplemental information on the four said components of financial statements. Again, we are POF Academy, your online training partner in becoming extraordinary and heroic professionals. For more training, visit us at https://page.popsys.com.